Welcome back to the channel Future CAs. I hope your preparations are going good. I hope you are confident about your exams. There is hardly 1 month left from here. So I hope your preparations are going as efficient as possible at this point of time. Coming to this particular video, we'll be discussing about the MCQs under MTP Series 1. As you all know, the MTP1, MTP2 and RTP released for the particular attempt, which will carry somewhere around 25 to 30 marks on the conceptual basis. That means it is not exactly the question which repeats in the main exam, but there will be questions which are similar or the same kind of sections will repeat under the main exam, which will carry somewhere around 20 to 25 marks in the subjective part and somewhere around 5 to 10 marks in the MCQs part. So this particular part we'll be discussing about, this particular video will be discussing about MTP1, the MTP1 of January 2025. Originally your attempt was proposed to be on November 2024, but because of the change in the structure, now they have shifted it to January 2025. This is series 1 of the paper. So coming to this, if at all, the first thing, don't waste your time to listen to the entire video if at all you have solved it already. If at all you have any doubt in a specific question, please skip to that particular question. I'll try to leave a timestamps in the description. And if at all you have not yet started this, we'll try to read the question in such a manner that you'll understand the question. We'll try to read the question in such a manner that we'll analyze the question in a better manner, and how to read it, how to present it how to read it and how to analyze the question will all be done in the same video. So please do stick till the end of the video to understand the concept of case studies. So here the first case study we have is, try to read it alongside me guys. The first case study we have here is Prakash Limited and Vasudha Private Limited were incorporated in January 1999. So these are the two companies we have. One is a public company, one is a private company, which got incorporated in the year 1999. By Mr. Vicky Tripathi and his family members. Both the companies are engaged in the business of manufacturing machineries used for agriculture sector. So what are the key points as of now? There are two companies. One is a public company, one is a private company, and incorporated by a person called as Vicky Tripathi. So make sure that whenever you read the case study, try to mark out all those important concepts or important situations that happened in the case study. Continue the process. Mr. Vicky Tripathi and his younger brother Vinay Tripathi actively participate in the daily operations of both the companies. Vasudha Private Limited is wholly owned by Tripathi family. Private Limited was wholly owned, and Tripathi family has a majority stake of 51% in Prakash Limited. So one company is a wholly owned company, another we have majority stake. Due to poor economic conditions in the agriculture sector and shifting of farmers' focus to more advanced farming techniques, the sales of Prakash Limited is dripping and its bottom line has been in the red for the last couple of years. That means they have been making losses for the last couple of years already. The unabsorbed losses of Prakash Limited for the current financial year is rupees 9.8 crores. That means they have a loss of 9.8 crores already. Prakash Limited didn't pay any dividend during the last 4 years. That means they did not pay dividend for last 4 years. Prakash Limited has accumulated profit. They have reserves of rupees 180 crores. So they have reserves of 180 crores. They have a current year loss of 9.8 crores. They did not pay dividend for the last 4 years. Continue the question, guys. Whereas paid up share capital of the company is 918 crores, and as per the latest audited financial statements, and a loss of 9.8 crores as we discussed earlier. This loss has not been adjusted from these reserves. Since pressure from the shareholders of the free float is mounting, management at Prakash Limited decided to pay dividend this year out of the accumulated profits. So as soon as I see this, what comes to your mind? So first of all, it is a question from dividend chapter, and which is expecting us to pay dividend out of my free reserve, the second source of dividend, which will apply rule 3 of the chapter, which states the conditions to be satisfied if the company wants to raise money from, pay dividend from free reserves, the accumulated profits. Finally, the dividend was declared on 31st August 2024, the date of declaration of dividend, 31st August 2024. Some of the dividend remained unpaid as on 30th September 2024 on account of operation of law, right? This was transferred to the unpaid dividend account, and the statement containing only names of such beneficiaries was hosted on the website of the company as on 9th November 2024. So now let's get the concept of this logic clear. It is a combination of section 123 and 124. First thing, section 123 states that once the dividend has been declared, the dividend must be paid within a period of 30 days, distributed within 30 days from the date of declaration. If at all it is not distributed within 30 days, such amount must be transferred to the unpaid dividend account within a period of 7 days. You got it right. Once the expiry of 30 days is completed. Understand the concept here. From the date of declaration, they're given a time limit of 30 days to distribute the dividend. If at all you fail to distribute the dividend in such time limit within 7 days, from the expiry of 30 days, you have to transfer it to the unpaid dividend account. The unpaid dividend account will be maintained by the company for a period of 7 years, and along with this, company has to prepare a statement which is going to contain three things: names of the persons to whom dividend was not paid, the last known address of such persons, the amount of money which is to be payable as dividend. These three categories of information must be mentioned about each and every shareholder to whom the dividend was not paid, and this statement must be prepared within a period of 90 days and posted on the website. Now, if you look at the question properly here, they have mentioned that the dividend was declared in as on 31st August, but it was not paid as on 30th September. That means the amount must be transferred to the unpaid dividend account, and they did so. They did transfer the amount to unpaid dividend account, but the statement so prepared here contained only the names. That is one non-compliance of the company here, the first point. Then it was posted on the website on 9th of November, which is within the limits because 90 days is given to us. Continue the process. Vasudha Private Limited is a mid-size unlisted entity with few branches abroad and is not required to appoint any independent director as per section 149 subsection 4. No independent director required for this company. During the immediately preceding financial year, its net worth was 280 crores and turnover was 590 crores and net profit was 48.5 crores. There's a huge net profit they have arisen in the last year. The profits and other information of the immediately preceding 3 years are given as below. So they have given profits as per section 198 for the last 3 years: 41.6, 42.9 and 28 crores. The last 3 years, and the current year they made a profit of, understand this guys, this is for the current year and these are the for preceding 3 financial years. Continue that. The board of directors of Vasudha Private Limited is not clear whether they have to compulsorily form a CSR committee. In order to avoid adverse legal consequences, the private limited has constituted a CSR committee comprising of 2 non-executive directors and 1 executive director who was appointed as a chairperson of the committee. Okay, fine. So let's start the question. Now understand this guys. The first company which we will be talking about is the Prakash Limited, the public company. We'll be discussing about the concept of the payment of dividend in this part. And the second company, the Vasudha Private Limited, will be talking about the process of independent directors and the concept of constitution of CSR committee. So the applicability of CSR procedures under 135. So coming to the first question they have given, in case of Prakash Limited regarding the unpaid dividend, which of the following statement is correct? So they have not given a question, they are only asking whether the statements given in the question options are correct or not. Let's start the elimination procedure whenever this type of question is asked. The first, let's start from the beginning here. Prakash Limited is guilty of non-payment of dividend because some of the dividend remained unpaid even after 30 days of declaration. If you go back to the question, the dividend was not paid on due to the reasons of operation of law, which is one of the exception for penalties under section 127. Remember 127 we had the penalty, and after the penalty these penalties will be imposed only when it doesn't fall under the exceptions, and we had 5 exceptions. The first exception was when the dividend was not paid due to the reasons of operation of law. Hence, the company was liable or not liable. Hence, the first option is not correct. So, I'll eliminate that. Coming to the second point, Prakash Limited is guilty because the list of beneficiaries of unpaid dividend is hosted on the website after 30 days. Remember, the statement was to be prepared within 90 days, but it should be transferred to unpaid dividend account within 7 days. So this is also not correct information here. Then Prakash Limited is guilty because of the list of beneficiaries does not contain the last known address and the amount unpaid on such shares. This is one of the correct options, but let's, to be on the safer side, read the last point also. Prakash Limited is not guilty because it is fulfilled all provisions of law pertaining to unpaid dividend. No, they did not prepare the statement properly. Hence, the answer here would be option number C, where the company prepared the statement, but the company forgot to mention 2 additional things in the statement. Originally speaking, the statement must be having 3 informations, right? The first, the last known address, sorry, the name of the person on whose shares the dividend is not paid, the last known address and last known email addresses of such person, and the last category would be amount unpaid on such shares. So second question, which talks about during the current year, is Vasudha Private Limited required to constitute CSR committee under the provisions of Companies Act 2013? If you go through section 135, we have 135 subsection 1 especially, we have the applicability of CSR, which talks about having a net worth of more than equal to 500 crores, turnover of more than equal to 1000 crores, and a net profit of more than equal to 5 crores. If any one of these limits are satisfied by the company, they have to constitute a CSR committee. If any of these limits are satisfied in the preceding financial year, and if you look at the question, they have not satisfied the limit of net worth or the turnover, but they did satisfy the limit given for net profit. Hence, they have to constitute a CSR committee. Now, continue the answers here. No, because it is a private company. Wrong answer. No, because the company's net worth is less than 500. Remember, it is or, which can satisfy any one of the limit, and we have to constitute a CSR committee. Yes, because despite being an unlisted company, its turnover is above 500. No, turnover should have been 1000. Yes, because the company meets the threshold criteria having net profit of exceeding 5 crores in the immediately preceding financial year. So, hence the answer was option number D. Moving on, question number 3. What is the implications of the fact that Prakash Limited has not paid dividends for the last 4 years while having reserves? The first question I'll ask here is whether payment of dividend by a company is mandatory or optional. Yes, you got it right. The payment of dividend was always optional in nature. Dividend is at the discretion of the board of directors whether to recommend or not to recommend. If the board of directors recommend an X amount of dividend, the company can declare either the same recommended dividend or less than recommended dividend. If at all the board of directors recommends 0, you are not required to declare any dividend. So payment of dividend is mandatory or just an option given to the company? Just an option. So let's go through the options here. The first option given is the company is in violation of the Companies Act for non-declaration of dividend. That is not the right answer. The shareholders can legally challenge the management for non-utilization of free reserves for dividend. It is not mandatory to declare dividend, hence the shareholders cannot take an action on the company in the case. There is no legal obligation to declare dividend even if the company has free reserves. That is a rightful option. The company must now use all the free reserves to pay dividend. No, we are not allowed to use all the free reserves. We have conditions under rule 3. So the option was option number C, where the company is not under any obligations to pay dividend. Even though dividend is not paid, it is not an obligation, it is not a legal consequence on the company. Then fourth question, considering the legal provisions regarding the constitution of CSR committee and the one constituted by Vasudha Private Limited, state which of the following statements hold true. So constitution of CSR committee is mandatory because we have seen in the previous question that CSR was applicable to the company. If CSR is applicable to the company, they have to constitute a CSR committee with 3 directors, out of which one must be an independent director. But if at all you are a company which is not required to appoint independent director, you will be constituting the CSR committee with 2 directors, and in the given case they have actually appointed 3 directors in the CSR committee, and one of them, the chairman of the CSR committee, was executive in nature. So what will be the answer here? Constitution of the committee is invalid because it does not constitute an independent director. Company did not even had the independent director, hence that requirement is not there. Constitution of the committee is invalid because its chairperson is an executive director. There is no context of the chairperson being executive or non-executive under Companies Act. Hence, please don't get confused in the process. It is only the concept that it must be 3 directors, out of which one must be a independent director. If there is no independent director, will constitute with 2 directors. That's the only concept, guys. So there is no dilemma about whether chairperson should be executive or non-executive. So this is also a wrong answer. Constitution of committee is valid because it depends purely upon the discretion of management. No, it doesn't depend upon the discretion of management. It depends upon the company law. They have clearly established on who should be constituted in the CSR committee. That is also wrong option. Constitution of the committee is valid because company is required to appoint is not required to appoint independent director. So option would be option number D, where it is not required to appoint independent director. They can constitute the committee without that independent director. Last question. What is the minimum amount to be spent by Vasudha Private Limited on CSR activities for the financial year 24-25? If you remember, the amount to be spent for CSR activities is 2% of the average net profits of the immediately preceding 3 financial years. I don't have my calculator here, so let's calculate, guys. You pause the video if you don't have your calculators, bring your calculators and start calculating with me. What's the average of the last preceding 3 financial years here? 41.6 plus 42.9 plus 28. We have a total profit in the last 3 years as 112.5 divided by 3 on average. 37.5 is the average net profit in the immediately preceding 3 financial years. Out of this average, we have to contribute a minimum of at least 2%. So that comes up to be 0.75 crores. So do we have an option of 0.75? Yes. 75 lakhs. The answer is an amount of 75 lakhs must be contributed. This will be the minimum amount of contribution to the CSR activities. That's your case study 1. We have taken somewhere around 15 minutes to complete the case study. It should take you guys a lot lesser because I'm trying to explain the concept at the same point of time. So it should take a lot less for time for you to complete this. Even though 15 minutes, 10 marks of answers are done, good enough. Continue the second part. We'll go a little quick on this. Rahul and Meenakshi, two young entrepreneurs, founded Educom Innovators LLP. So it is an LLP question now. Under the Limited Liability Partnership Act 2008, with the focus of providing digital education solutions. Rahul brought technical expertise while Meenakshi managed the business operations. Fine. According to the LLP agreement, both contributed equally and shared profits equally. After 2 years of growth, they decided to admit Anshul as industry expert as a partner to expand their reach. So they appointed another person to expand the reach, a person called as Anshul. So highlight the key points here. First of all, it is an LLP. Second of all, they had two people, Meenakshi and Rahul. Later on, after 2 years, they appointed Anshul to bring in some expertise into the business. However, shortly after joining, Anshul discovered that certain key compliance filings, including form number 11, that is your annual returns, and form 8, the statement of accounts and solvency, your financial statements, were pending. So they did not file these documents. Fine. Considered, Anshul wanted to understand his liability and insisted that the LLP immediately addresses the compliance issue, right? Meanwhile, Rahul proposed to amend the LLP agreement to reflect Anshul's new profit sharing ratio and allocated specific decision making powers to him. So first of all, as of now, the Anshul's problem here was the company, the LLP, did not file its accounts and solvency and the annual returns in the last 2 years, and Anshul got admitted into the LLP. Is he liable for the activities? As we have learned it from the partnership at the beginning also, the admitting partner, the incoming partner will be liable only for the activities after his admission, for the future activities. Whatever activities that have been done in the past will be the liability of those partners who are present in that period of time. So whatever non-compliances that have happened for non-filing of these two regulatory documents will be on the first two partners but not on Anshul. That's the problem solved first. Then second category. As they worked through these matters, they consulted a legal advisor to understand how the LLP impacted, Limited Liability Partnership Act impacted their responsibility, liabilities and compliances obligation. So first thing you have to get it clear is the business operations of the company are the responsibility of all the partners, but when it comes to the compliance procedure of filing all these documents, communicating with the ROC, etc., these compliance procedure are the responsibility of only such persons who are designated as a designated partners, who are considered as designated partners. So with that being clear, let's start the MCQs. When Anshul joined Educom Innovators LLP, he discovered that key compliance filings, including annual returns and statement of accounts and solvency, were pending. What is Anshul's liability as a new admitted partner concerning these past compliance lapses? So we have discussed this already. The new partner, the admitting partner, incoming partner will be liable only for the future compliances, future regulations, not for the past one. So continue the answer here. Look at the options. Anshul has no liability for past compliance lapses since he was not a partner when they occurred. This is a rightful option. To be on a safer side, I'll go through all the other options also. Anshul shares equal liability for past compliances. No, he doesn't share any equal liability. That's not the answer. Anshul is only liable if the LLP agreement specifically assigns responsibility to him for compliances. There is no logic of tri-party agreement under LLP provisions. Anshul liability for past compliances is limited to his capital contribution. No, the answer would be 1. Option A. He is not liable for the past activities. Chalo. Question number 7. In the light of Anshul's concern about the pending compliance filings, which of the following best describes the responsibility of the partners in Educom Innovators LLP regarding compliances with the LLP Act 2008? Only the designated partners are responsible for ensuring compliance with filing obligation. That is the right answer, because compliances under LLP are a responsibility of the designated partner, but business is a responsibility of all the partners. All partners, including new partner like Anshul, are equally responsible? No. Compliance responsibility can only be assigned to one partner? No. The legal advisor is responsible? No. It is the responsibility of the designated partners. Option A. Only the designated partners are responsible for that. And they have not given in the question who is designated partner, so don't think further on that. Simply the answer was designated partner is responsible for the compliances there. The last question of the case study. Suppose in the given scenario, Educom Innovators LLP fails to file the statement of accounts and solvency for 5 consecutive years. Remember, we had a concept, and one of the important concept of LLP, winding up of a LLP by an order passed by tribunal. The very first point, the third or fourth point in this process was where the LLP has failed to file statement of accounts or solvency or the annual returns for a consecutive period of 5 years. The NCLT, the tribunal, may pass an order for winding up. So continue the process. Option A, may wound up, that is the right answer. Takeover of the LLP by persons appointed by the Register of Companies? No. Revocation of all partners' rights until filing are completed? No. The losses of these 5 years will be shared by such partners? No. The option obviously is first, where the tribunal has a power to pass an order for winding up of such LLP who has failed to file their annual returns and statement of accounts and solvency for how many years? 5 years, 5 consecutive years. Chalo guys, the next case study is a small case study. Quickly go through that. In 2024, a company specializing in international trade, needed to send an import notice to one of its clients, Mr. A, regarding a contractual amendment. Fine. The company which is sending a notice to its client. According to the company's internal regulations and the contract terms, the notice had to be served by post. Okay, fine. Notice was to be sent by a post, only by a post. On April 15, 2024, the company's legal department prepared the notice and addressed it to Mr. A at his registered address. So they have actually addressed it to Mr. A and sent it. The notice was properly addressed, prepared and sent via registered post with acknowledgement due. As soon as I see this word, my senses say that it should be a question from General Clauses Act. Registered, the serving of notice. How should a notice be served? You have to satisfy 3 things. It must be properly addressed, it must be prepaid, and it must be sent only through a registered post having acknowledgement due to ensure that highest level of conformity of delivery. A few days later, on April 20th, 2024, the notice was written with a stamp indicating that it was not claimed by Mr. A. Fine. We have this under the note points of the provision where if at all the document is considered as not claimed, it is assumed to be served. If the document is sent but the other person, the receiver, the recipient, doesn't accept it, doesn't claim it, doesn't receive the document, it is assumed to be served. We have seen this in the case studies we have learned. The legal department recorded the return of the notice and noted the endorsement. The company's legal advisor referred to past case laws for similar scenarios to ensure that the notice was considered legally served under Section 27 of GCA. They reviewed the following precedents. So they had gone through the different case studies that happened for the service of documents. The first case study, the United Commercial Bank versus Beam, where what happened in this case study? It was noted that merely sending a notice by registered post without acknowledgement due did not provide sufficient legal protection for proving service. So what's the process here? They simply wanted to say that the registered post is not enough. We have to send a registered post acknowledgement due. Only then it is considered to be a valid service of document. Second category, the second case, Jagdish versus Nattu. This case demonstrated that if a notice sent by registered post was returned with a refusal endorsement, that means the recipient has refused to accept the document, it is considered to be served. But in the question they have asked, they have used the word not claimed. That comes from the case study. The second case study we have, Vandana versus Gurmeet. It was established that if a notice sent by registered post properly addressed was written with endorsement like not claimed. They did not accept it. It was deemed to be served. Chalo, start the questions quickly, guys. According to Section 27 General Clauses Act, what three conditions must be fulfilled for a document to be properly served? Given the three conditions, it must be properly addressed, it must be prepaid, it must be sent through a registered post, acknowledgement due. Given the answer here, what are the options here? We have properly addressed, prepaid, but post by ordinary post, no. Properly addressed, prepaid and registered post, it is the right answer. Properly addressed, prepaid, but courier, no. Properly addressed, prepaid and hand delivery, no. The option B, it should be properly addressed, prepaid and sent through a registered post. In case of United Commercials Bank versus Beam, the second case study we have, so the first case study which we have had the problem where the post was sent through registered post but not registered post acknowledgement due. It was not considered as properly served because it was not through acknowledgement due. So why was the presumption of service under registered post found to be insufficient? Because the notice was not sent by ordinary post? No. Because the notice was sent by registered post but not acknowledgement due. Option B. Because it was addressed incorrectly, because recipient did not respond. No. Option number B. 11th question, the last question of the case study format of questions here. So quickly complete. What does the case of Jagdish versus Nattu demonstrate about the service of notice? What was the case study? Go through the question again. The second case study we have, Jagdish versus Nattu, stated that if at all there is a refusal endorsement, it is still assumed to be served properly on the recipient. So based on that, quickly answer them. Notice sent by registered post without written endorsement is invalid. Notice sent by registered post and written with refusal endorsement is deemed served. So ICAS is basically stating that read the case study properly, you have the answer there. There is no complication on this question. They have actually given you the case study, they have given you entire wordings, you just have to read the question properly, you are done with the answer. Hello guys, moving on to the independent case scenarios from here, question number 12. So what is question number 12, sir? ABC Private Limited is a project engineering, procurement and construction company. The company has bagged a contract from government of state of Kerala for construction of water dam. So they have bagged a project for construction of water dam, right? The company has involved a project consultancy firm situated in Australia for preparing techno-economic feasibility report to enable it to start construction work of dam. The company had paid US dollars, that is 70 lakhs to vendor of Australia. Now, I hope you guys will be able to recollect this concept. Now start analyzing the logic. First of all, it is a payment of fees for a particular service. So it will fall under the category current account transaction. Remember, the transactions were divided into two categories: capital account transaction and the current account transactions. Current account transaction were again divided into three categories: Schedule 1, Schedule 2, Schedule 3. Schedule 1 talks about prohibited transactions. Schedule 2 talks about permissible transaction but with the prior approval of central government, the ministries of central government. And the third category, Schedule 3, talks about transactions which are permissible but with the prior approval of RBI. And within that category of Schedule 3, the permission of the prior approval of RBI, we divided the logic into two categories again, for individuals and other than individuals. For other than individuals, we had a concept called as consultation services, and the logic of consultation services were again divided into two categories, for infrastructure project and other than infrastructure project. If it was infrastructure project and the amount of consultation services remitted out of India is exceeding 1 crore US dollars, only and only then you have to get a prior approval from RBI. But in the given case, as the amount of remittance was 70 lakhs US dollars, which is within my limit of 1 crore USD, then the approval of RBI is not required. Company can actually go and make this payment without the approval of RBI. Chalo, the company, the second part of this question, the company also availed the service of software company situated in Denmark for the migration of its accounting software from SAP to Oracle, for which the company had paid US dollars 20 lakhs to the software company. And sir, because there is no infrastructure involved in this procedure, it will fall under the other category, other than infrastructure project, where the limit provided by FEMA provisions were, current account rules were the 10 lakh US dollars. If you remember, USD 10 lakhs was the limit provided for other than infrastructure. Anything about 10 lakhs, I have to get a permission from RBI. Because of the fact that this is 20 lakhs this time, which is exceeding my limit provided under FEMA provisions, I have to get a permission from RBI. So let's go through the options here. The company can make payment of 70 lakhs and 20 lakhs without any approval. The answer is wrong, because as the conclusion was 70 lakhs of infrastructure project was within the limit, no approval is required, but 20 lakhs of the limit, 20 lakhs of the software services other than infrastructure is exceeding the limit of 10 lakhs, approval is required. Second option, the company can make payment of US dollars 70 lakhs without any approval and 20 lakhs after obtaining prior approval of RBI. That's the right answer, but let's go through the other options to make sure it is right. The company can make payment of 70 lakhs and 20 lakhs after obtaining prior approval. No, 70 lakhs did not require approval. And the last category, company can make payment of 70 lakhs after obtaining prior approval of RBI and 20 lakhs without approval. No, the option was B. The option B for the purpose of infrastructure project. I know FEMA is a little difficult to remember, especially when it is having so many points to remember. Will definitely as soon as possible come up with a proper revision of FEMA in your on a YouTube channel. Stay tuned for that, guys. So moving on, Mr. Narayan Services had enrolled himself for management course of 3 years with IOL, Indian Oil Limited, Mumbai. Out of 3 years, 2 years of educational course would be provided at campus of IOL, Mumbai, and 1 year of education course would be provided at University of Auckland, okay, under student exchange program. Mr. Narayan Srinivas is required to pay tuition fee of rupees 10 lakhs directly to IOL, Mumbai for 2 years course and US dollars 2 lakhs to University of Auckland. Fine. Mr. Narayan had left India. Fine. This is a question regarding PRO, I assume. He is leaving India on 20th of August 2024. So my suggestion would be, whenever there's a question coming from PRO, make sure that you write the proper dates separately, then we'll start analyzing the process. He left India on 20th of August 2022 to complete his degree from University of Auckland. In the last month of final year of his course, he got an offer from one of the reputed companies situated in Auckland, and he accepted the offer and he decided to work there. Fine, he continued to work there. On 1st September 2023, Mr. Narayan had visited India for 30 days. So he came back to India on 1st September 2023 and again left India to meet his family, and on 1st of October 2023 he again left India. So he stayed in India only for 30 days in this particular financial year. That's the question. So that should be the question. Give me his residential status. So continue the points here, guys. In the financial year 22-23, he is going out of India for studying abroad. If you remember the RBI's clarification given on studies abroad, if a person is leaving India during the financial year for studies abroad, he will be automatically considered as a PROI. And for the financial year 23-24, he came to India and he stayed in India only for 30 days. Hence, he is also classified as a PROI. But in the financial year 21-22, where his stay in the preceding financial year was all in India, 365 days, where he was studying in India in IOL in Mumbai, he was considered as a PRI. Now look at the question what they have asked us. So they are asking us to classify all the procedures. Mr. Narayan Srinivas is treated as a resident of India for the financial year 23-24, 24-25. So 23-24, because he is staying outside India, he should be classified as the PROI. Hence the first option is wrong. Mr. Narayan Srinivas is to be treated as resident in India for financial year 22-23 and 23-24. 22-23, 23-24, both the cases he is a PROI. One regarding the RBI clarification, one regarding the preceding year's 182 days stay. Chalo. Mr. Narayan Srinivas is to be treated as non-resident for financial year 23-24 and 24-25 as he left India for higher studies. Remember this, the RBI's clarification in this topic. If a person goes outside India for higher studies, then he abroad studies, he will be considered as a PROI immediately. So this is the rightful answer. Let's go to the last option also. Mr. Narayan Srinivas to be treated as resident in India for financial year 23-24 since his stay in India for more than 180 days, and non-resident for financial year. No, because yes, the concept is correct. His stay was more than 182 days in the preceding year, but if at all it is studies abroad, we have a specified clarification on this. So this is also not the right answer. So answer was he is a PROI, non-resident for both the years. Chalo. Next question. Green Tree Limited is planning to issue debentures to the public, and as per the legal requirements must appoint a debenture trustee before making a offer. This is a question on debenture trustee now. The company is considering several individuals for this role. So we had, remember, the disqualification of debenture trustee under 7 points. So let's go through the points here. Mr. Sharma, who owns a small number of shares, a person who beneficially holds any shares in the company, is not allowed to be appointed as a debenture trustee. The second disqualification we have learned. So this person is not allowed to be appointed. Second case, Ms. Kapoor, who previously lent 5,000 to Green Tree Limited and is currently a lender, a person who has been indebted to the company or the group companies, including the subsidiary of the holding company, is not allowed to be acting as a debenture trustee. So Ms. Kapoor is also not allowed to be appointed. She is disqualified. Last case, Mr. Verma, who has provided a personal guarantee to ensure the repayment of debentures issued by Green Limited, a person who has given a guarantee to the company, is also not allowed to be appointed as a debenture trustee. He is disqualified under point number 5, as we learned in the class. So these are the 3 cases. All the cases, they are disqualified based on the provisions of Companies Act 2013 and relevant rules. Who among the following is eligible to be appointed as a debenture trustee for Green Tree Limited? None of them can be appointed. Option is. So the final question on this, Best Limited initially created a charge in favor of LKJ Bank for a financial facility. This charge was duly registered. So they created a charge and the charge was also registered with the ROC. Few months later, LKJ Bank enhanced the credit facility by an additional 40 crores. However, due to an oversight, Best Limited failed to register the modification to the original charge with the registrar of companies. If you remember the concept, guys, the charge must be registered under section number 77. Within a period of 30 days from the date of creation of charge, it must be registered with the ROC. And if at all any subsequent modification that arise in the charge so registered already, we have to file under section number 79B, modification of a charge. But the company filed 77 but failed to file the modification of charge under section number 79B. Continue the question. The company has now realized this error and is concerned about the potential impact on the records on its records and compliances. As per provisions of Companies Act 2013, what steps should Best Limited take to correct the situation regarding the unregistered modification of a charge? To understand this concept, guys, whenever the charge is not registered or the modification of charge is not registered within a due time limits, we have extensions under section number 77. If you at all want to apply for extension, you have to pay either additional fee, or the second extension we have to pay an ad valorem fee. If you remember the chart we have done in the class before the before old law as well as the new law, we have divided the concepts and all. But if at all you exceed the specified limits under 77, only other option enter under your provisions of charges of Companies Act is section number 87, where the company will go make a request to the central government, requesting the central government to give a condonation for the delay which is made by the company and pass an order on the ROC for the rectification of the charge register. So what will happen here? Either we have to apply the procedures of 77 for extension, or if the time limit is exceeded, you have to go make an application to the central government. Central government, after being satisfied with the provisions, will provide a condonation for delay and pass an order on the ROC for rectification of its register. Give me the concepts here. Ignore the oversight. It is not possible. We have to register that. Re-register only the original charge with the updated facility amount. So we cannot cancel the original charge and create it with a new amount. That is also not an option. Then option number C. File an application with central government for rectification of the register of charges under section number 87 under form number CAG8. That will be the right answer. Let's go through the last point also. Contact LKG Bank to withdraw the enhanced facility until the registration is completed. No, we have to make an application to the central government for condonation of delay under for rectification of the charges. Will pass an order if the CG is satisfied for the process. That's all your MCQs under MTP series 1. If at all you have any doubts in these MCQs, any conceptual clarity which is required, please do leave a comment on this particular video. I'll respond back as soon as possible. And coming to the descriptive part, I've just gone through the questions here. None of the questions are tricky. None of the questions are hugely difficult for you to understand. All the questions are expected on all the questions are repeated questions already asked in the previous exams. So if at all you have done our question bank, every single question is present in this process. If at all you have any doubt on a specific question, please do leave a comment. I'll respond back, or if possible I'll make a video on that particular question, but not on all of them. All the questions are very easy, and don't be fooled by the fact that ICA is gonna give question paper in this particular format or this particular level of examination. These questions are asked with a lesser level of intensity to make sure that you revise the concept properly, not for exam perspective. In the exam perspective, paper will be a lot more lengthier and a lot more difficult for you. So just for practice purposes, go through these questions. All the questions are easy. If you have any doubts, please do leave a comment on this. I hope this particular video helped you complete the MCQs in a proper and timed manner. All the very best for your coming 30 days of preparation, guys. Thank you.